Welcome to the Dividend Talk podcast, episode 92, for quarter one 2022 portfolio performance. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to have a look over our quarter one results, and we also have plenty of news to talk about, so stay tuned for that. See you on the inside. Hey, European DJ. Busy week?
Yeah, definitely. I mean, wow, there was a lot of news this week, right? And I thought when we started prepare for the show, like, what happened actually this week? And then I started looking back at my notes and going through how the week went from an investing point of view, and I thought like, wow, we have a lot of news to actually talk about.
Yeah,
But how
yeah.
about yourself, by the way?
Oh, you can see I got a little bit of sunburnt. The sun was shining here over in Ireland a little bit. I'm actually only back from a trip to Anfield. I went to see Liverpool play yesterday, which they won, so I'm quite happy. I brought my kids over to get to sit in the famous Cop stand, and watch the game. So that was cool. But we had to fly back late last night because my boys don't like to miss football. They both had football matches then as well. So it's been a busy week, but really enjoyable.
I can hear it in your voice, so you probably had to shout a lot for the fan, as a fan, right?
Yeah, singing. You have to sing. I mean, nobody goes to the cop and just stay still. So you're singing and chanting and so on. So my voice still has to recover, but it's something that I try to do once a year myself. And my kids are at a great age now that I can bring them, and just to see their little happy faces was worth it. So.
Yeah, I will not ask you how much it costed and how much of financial freedom it has costed you.
Hey, I mean, in the show notes we have Dutch inflation has gone up, and we'll talk about that in a moment. But what I have to say is, it was really noticeable for me. The cost of living in the UK has gone up substantially. Usually when we go over there, I mean, things are cheaper. Like you go out for food or drinks, usual things, and they're a lot cheaper usually than Ireland. And what I found really weird was that not only was their price comparable to us, like if you were to take the currency out of it, if it costs five over here, it costs five over there. But then when you put the currency into it, it actually works out a lot more because you get less sterling than you do
Yeah.
for euros. So it was really noticeable this time compared to any time I've been over there. So it looks like Brexit and inflation is hitting those guys hard.
So you had to buy some smaller pints.
No, I'm not a lady. Come on.
Well, talking about that then, right? So you touched upon it already. Did you know that Dutch inflation hit 12% last year over year?
That's
I mean,
meant.
it's the highest since 1975 when there was the oil crisis. I think we have an oil crisis now as well, triggered by the war, of course, and
Yeah.
the supply chain and whatever is going on in the world. But 12%, even as an employee, you can't work against that. Which employer is giving you a 12% salary
No,
hike?
no,
Uh,
and even investors. I mean, like we're going to talk
yeah,
about our portfolio yield and stuff. I mean, up against 12%, but we're at a disadvantage straight away, right off the bat.
yeah, yeah. So I mean, I don't know how long it will take, but I think this will also take put again pressure from northern countries to towards the south in Europe to really start increasing these interest rates
Yeah,
because it's so hot the market at this moment, and 12% is not sustainable, really
it's it,
not.
it's nowhere near sustainable, but we'll see how it plays out. Have you noticed? I don't know in Poland, but have you noticed that going to the shops that there's everyday items are not there as much as what they used to be. Like for example, over here, vinegar or mayonnaise. Like we could go to a shop on any given day,
Mhm.
and the supermarkets are empty sometimes. We've never seen that
Yeah.
before. It's quite crazy.
I've not noticed it. Lidl is really booming here. It's
Yeah,
full. So I've not noticed it myself. No.
Yeah, it's very strange, and we shop in Lidl or Aldi, and we've noticed now it's not as if they're not there all together. Like we could go down on a
Mhm.
Monday and it's not there. It might be there Tuesday or Wednesday, but it's still quite a strange experience because these things
Okay.
are never not
Yeah.
there. So I'm just wondering if it's throughout Europe or where these supply chain issues are
No,
coming from.
no. I mean, let's say if a truck goes from Ukraine with food or something like that, like sunflower oil, stops first in Poland before it comes to Ireland, I guess. We
I'd like
just unload the trucks on the way to Ireland.
you take all our mayonnaise.
Exactly. Why not? But if we are on this topic, also the yield curve started to invert, right? And I know this always spooks a lot of people because then they always say like, there's a recession coming, and it might well be. I think the last time the yield curve inverted was also in 2020, but
Yeah,
we know what happened since then. Still crazy stock market. But it is of course when you think about yield curve, it is of course an awkward phenomenon. So that people link it to an upcoming recession, I can understand that, right? And honestly, I wouldn't mind if the market cools off by, for instance, increasing interest rates, because for few things also our dividend stock should tank and provide us better yields to nibble into, right? So I wouldn't really mind as long as it keeps my job safe and your job safe, right? I think that's always the thing
yeah.
with a recession that you don't want to have.
A recession is a double-edged sword, isn't it, for investors? Because on one hand you get cheap stocks or companies, but on the other hand, if you lose your job or if money is not available, you can't take advantage of that. So it's kind of
Exactly.
a double-edged sword. But I'm reading about the yield being inverted. I think 2019 is when it happened, and then obviously
Hmm.
it took some time. It took the pandemic. Then was the trigger
Yeah.
to send it into a bit of a downturn. So it's not as if just because this goes inverted, it's going to crash straight away.
Yeah.
It could take some time. It might take some sort of event. So we don't know what will happen, but it's definitely based on history. It looks like we will be hitting a recession soon.
Well, I hope so, because yeah, we'll actually get later to it in one of the listeners' questions, but it gave nice opportunities, I would say.
Yeah.
So yeah, if we then go, if we stick a little bit to this, what's all going on in the world? Have you also heard that Putin wants us to pay in rubles now for gas and all what's there?
Yeah, I heard that last week or the week before. I remember him saying that, and to be fair, it's obviously a defense mechanism for him to protect the currency. And
Yeah,
the last time I've seen, which was before I went to Liverpool during the week, was that it had fully recovered. It was past. It was better than what it was before the war started, which is mind blowing.
crazy. Yeah.
Yeah,
Yeah, so what I'm wondering now, right, is that like Shell and I believe also ExxonMobil, they disposed of their assets in Russia. So did Gazprom get them now, and did therefore Gazprom become much more asset rich, let's say? And if, let's say, in 5 years from now, Russia, let's say that Russia comes to its sense and things start to recover. I mean, does it mean that the Gazprom now, instead of having a joint venture with Shell, for instance, in the Sakhalin area, which was, I don't know, 60-40, now became 100, so they got 40% of the assets, that it becomes a better value play? I mean, I got some questions from people whether we should buy Gazprom. I'm really not doing it. It feels morally so wrong to support Russia with what they are doing. But it is interesting thought for me to think like, okay, so Gazprom, did it got now all these nice, brilliant ExxonMobil and Shell assets handed over,
yeah.
and does this unlock value for greedy investors?
I mean, there was no doubt that there was most likely value or money to be made from this. There's no doubt about it. I mean, some investors, or at least retail investors, might lose some trust in Russian companies and Russian assets, and
Mhm.
how do they get that money out if something like the stock
Yeah,
market is closed now, right? Okay, but big guys, the big players, they might not have those problems because they tend to get signals before we get signals.
yeah,
So I'm pretty sure that if this is going on, that there'll be a lot of people make some money out of. But I just find it so wrong. I do. I really do. It's
yeah.
To me, it's morally wrong. I couldn't do, but again, I'm a retail investor, so the risk is
Uh,
far
me, me,
far
me me
greater.
neither. Me neither. I'm just like more like thinking like to who does this stake now go? Because Shell had, for instance, a joint venture with Gazprom. So I assume that Gazprom is now full owner
Yeah,
of the asset and the stake, and Shell not anymore. So Gazprom is generally a beneficiary of this. And if China keeps continuing buying gas in India, of course at a lower price, as I understand, but let's assume it recovers. Then there's only one winner here, and that's Gazprom and the Russian government, right?
yeah,
Really, really awkward when you think about it.
yeah. We'll see how this plays out. I mean, look, we do know the world is greedy and money is
Yeah.
money is the ruler of all. So we'll see how it plays. But good luck to him. I see. Actually, moving on to Chesnara, I see. I know you have a video out about these guys. They announced the results, which look pretty strong, and they increased their dividend as well, which I think is quite reasonable considering their high starting yield.
Yeah, yeah. I think I bought Chesnara last year when I initiated the position. I straight away built it out to full position because it's like a tier four for me. So like 1% of my portfolio or something like that in the end. Um, Yeah, I bought it, I think, then at a 9 point something, 9.1 yield on cost. It grew 3%, so it's 9.6% yield on cost now, but the actual dividend yield is now 7.6. Chesnara is such a boring insurance company. So for people that don't know what it does, it buys such, let's say, policies from existing insurers, which are close-ended, so they are not anymore taking new customers our policyholders, and then they just squeeze the last bit of money out of it. And they've been doing this pretty well, and they started to diversify also now into some open policies where new customers are being marketed. And it had just a good year. So the CEO changed as well. So it is also to be seen if the CEO can be as boring as his former CEO. And I think this is really important to have the most boring CEO for such a company. But also, it's just humbling. I said it's just humming along. So
Yeah,
I like this one. It's I feel really safe with this company. I know that some people look at it and say, "Oh, where's the cash flow?" But this insurance company. You need to look different at it. And I think they have a brilliant investor relations website. So just look at the PowerPoints that they provide, and they tell you like with a 1.5 coverage. So what they effectively know is like, okay, so much money is left in this portfolio, so we know what we can make out of this. We know what our expenses is. It's 1.5, let's say, in a factor, and they know they can pay a dividend from it because overall they are growing their asset base by acquiring new small portfolios. So, and you cannot really look at it from a net income point of view or free cash flow because these insurance companies by itself are already really hard to look at. So yeah, I think people would need to look at my video, but if you take the regular let's say metrics, they will force you into thinking this is a company to stay away. But if you start looking under the hood, you will see that there is actually kind of good stuff for the small cap. But it's a small cap, it comes with increased risk, so you need to be willing to take that risk, right?
yeah, and of course they don't have a high yield for no reason. There's obviously
Yeah.
an inherent risk, and as you said, insurance companies are complex. These are a little bit more complex than others, based on what they do. So it's quite difficult to analyze these guys. And
Yeah. But like, what is it? 16 or 20 years dividend growth history,
yeah,
uninterrupted. I'll take it.
and a 3% dividend hike, which I mean, I've seen some people give out about it, but I mean, they have a 7% dividend yield. I mean, what more do you want?
If they do it next year again, then in 2 years I have a 10% yield on cost. And then imagine like if I hold it for 10 years, I will have earned all my money back in dividends and not even considering reinvesting, which I'm, by the way, not doing in Chesnara. I'm reinvesting the money elsewhere because it's already full position for me.
No. Okay, and the last thing on the news then may interest more European investors, because we know the tax system over here is really complex. We've got different countries all with their own laws. We pay different taxes based where they're from. So France, Switzerland, all this. But there seems to be discussions now happening now where we're starting, well, hopefully going to look at standardizing this across all of Europe.
Yeah. So yeah, they are looking at a new European Union system to avoid double taxation. This is already a little bit of an older story. It started last year already. Then you could give some feedback. They propose some things, and this is going so slow. So don't expect anything to happen in the next 3-4 years, right? But what they effectively want to do is they want to, I said, for the European Union and the Commission, cross-border taxation and to simplify it is a priority for them. That's what they at least say. They have tried to do already things, but it has never really worked out into the favor of the investor, let's say. So what they are trying to do now is to really introduce a common-wide system which allows sharing of data also between countries so that they can cooperate with each other, specifically around withholding tax on dividend or interest payments. So my dream with this is that, for instance, I don't need to do all of this stuff anymore with the forms, and that the Polish government knows exactly how much dividend I earned abroad, how much was withheld at source, that there's no double taxation, that also at source they are not, let's say, in Germany taking 26%, but just 15%, like what we have with the forms in America, that we can do this automatically via our broker by just ticking some boxes. We register and it's all done. And at the moment, now, I think it is for the next 2 months, there's a feedback period. So I'll put the link into the show notes. I would like to ask every listener that is interested in this to really raise their voice and give feedback to this, how is it, regulation that they are trying to create. So they're now looking for European citizens to give their thoughts. So I'll put the link in the show notes, and please, guys, give it a look. It will probably take you 10 minutes or something like that. But as a community, who knows, maybe we can give a voice and really stand up for the retail investors here. So that's what I'm doing as well. And yeah, I don't have too much hope knowing how governmental bodies work, but I rather, I say, participate than watch at the sidelines and don't try anything at all.
Yeah, I mean, we have to raise our voice, and look, usually when something like this, when they're going across countries, it's going to benefit probably not the retail investors. It's obviously going to benefit people up the chain, but maybe there might be some bit of hope in there for us. You can see why it's hard. I mean, you got countries by your own admission like Poland who are not as IT savvy in this world where everything is still probably paper, and then you probably got Germany, Ireland. To be fair, is quite good in that regards. Everything is done automatically now as well, so it's look. It'll be interesting to see how it works out. But I hold no hope that it'll benefit us. I do hope that it gets rid of this stupid deemed disposal rule that we have in Ireland with regard
Mhm.
to ETFs, because then ETFs might start look a little bit more attractive to me and to Irish investors. So we'll see how it goes. Okay, so the main topic is our portfolio review, and I'm quite interested to see how you've done this quarter.
Well, I've actually done quite well, I must say. My portfolio grew with an approximate, let's say, 11% compared to 31 December last year, 21. So in 3 months, 11%. But I must confess, approximately, let's say, 60% of that number comes from net contributions, and the other 40% comes from strengthening dollar and a little bit of share price appreciation. So most of it comes mainly from net contribution. For me, the portfolio value as such is actually not the real measure that interests me the most. I think, and I back on the napkin, also my projected annual dividend income grew with like 8% quarter over quarter. And that's what I'm most happy with, because that means that the compounding is real. A lot of this is also because of the dividend hikes that we're rolling in quarter one. So I could update therefore all the future dividends. And that's why I'm having now more projected annual dividend income, or PADI, as we call it in the community.
Yeah.
What did I buy this quarter? I bought Viatris. I initiated a position in this. I initiated a position in HP Inc. HP with ticker symbol HPQ.
Yeah.
Viatris, by the way, has a ticker symbol VTRS. Then I initiated a position in Texas Instruments with ticker symbol TXN, and in Castellum, the Swedish real estate investment trust, with ticker symbol STO CAST, CAST. Then I also added more to my position in Unilever when it dipped to 42.50, I think in January. I added more on Intel when it dropped towards 45, and I added more in Facebook, or it's called Meta Platforms with ticker symbol FB, on the dip when it dropped suddenly also from, where was it, 300 all the way down. And last but not least, I bought last week, I believe, some 3M with ticker symbol MMM, also because it was not a lot, but I thought, like, okay, why not? Uh, the litigation is real, of course. I'm a bit concerned about that, but I thought, like, let's nibble in some. If they do well, then at least I use the opportunity of the dip. And I also reinvested some dividends in Unilever and Shell, because those two Dutch companies are the only companies I can reinvest dividends in via my broker. So also there, quite happy with specifically these new four positions. Texas Instruments, I was so much looking forward to. So I'm really proud that I have it in my portfolio. It's a true compounder. I believe they compound in cash flow 11 or 14% on an annual basis. I mean, crazy. And I really think that this semiconductor industry is still in a large boom. So, I mean, I'm really happy with it. I believe the yield was 2.75% that I got it for. I'm really happy with this.
Yeah.
So if I then look at the dividend income, so the real net dividend income after tax, in January it grew with 4.4%. In February it grew with 9.6%. This is all year over year. And in March it grew with 33%.
Wow.
And March was really a big month for me, and specifically the dividends from BHP that came in. They were so juicy. These mining companies like Rio Tinto and BHP, wow, they have a lot of cash to share with us at the moment with these commodity prices and such. And I think there's more dividends to come out of those two positions. But on average, my net dividend income in quarter one grew with 23%. And this keeps astonishing me, because we're talking here about being 6, 7 years on the journey, right? And I would have expected the year-over-year growth to flatten more and more and more, because, if you go from 50 euro to 100 euro, it's a 100% increase, right?
Yeah.
But 23% is so much still for me. And I know I'm adding every month again. I'm investing, but oh boy, 23% compared to last year is just a shitload of money. Really a
Oh,
lot.
it is a ton of money, but you have been adding quite a bit more this year, have you, than you have over previous years, maybe?
Yeah, yes, I've been adding a lot in quarter one, but this is money that is mainly based on ex dividends from my portfolio last year. Yeah,
Yeah.
because in May I might get some more from what I added in the first quarter, but in the first quarter, much of that I added, those dividends will still need to come in Q2 for the quarterly dividend payers.
Yeah.
Yeah, so this is almost pure based on just the investments last year and the compounding from last year.
Yeah, I think it highlights how compound, what are you, 6, 7 years into the journey, it just highlights how quickly that compounding actually works. And now you're starting to make, just from your dividends alone, you're probably making meaningful contributions every single month.
Yeah. Because if you look at it, let's say from a portfolio value point of view, I'm now on 41 or 43% of what my calculated, target value was based on a certain yield. So this is going fast, right? I remember last year we were talking about 33%, 30%, right? And now it's in the 40s. And of course, this is based on portfolio value, not on dividends, right? But even if I look at my dividend, I think it's around 35% now. If I look at my expense coverage ratio,
Yeah.
I mean, if this continues like that, and the reinvestments are really becoming nice now, we were just speaking before the show, um, based on the first quarter dividends, which is a low dividend quarter for me generally. This one will be high. It is almost a monthly contribution for me.
Yeah.
Yeah, and that's just insane. It's just amazing that almost one full quarter can lead to a free contribution of monthly savings. I love it.
So
I really love it.
you're getting 4 months free every year at the moment.
Yeah. That's what you could say. Yeah, exactly. And that's the true power of compounding, right? And that money will get compounding again. So and it's like really snowball effect. But hey, if we then look from a portfolio yield, it decreased slightly from 3.2 to 3.18%. I said the largest sector still in my portfolio is technology with 24%. And tada, Microsoft, after having been 3 or 4 years the largest position in my portfolio, has been overtaken by Royal Dutch Shell, Shell PLC now. It is now the largest holding with 8.26%. I think I don't need to give a lot of explanation what happened to our oil companies, but yeah, it has been a good quarter. I didn't expect it because the market was really hectic. And yeah, just generally my portfolio is doing well, I would say.
Yeah, and 33% towards your goal of dividend income is quite impressive. I mean, it was around 20% this time last year, I think, was it? It was,
It was much less. Yeah, I don't remember anymore.
yeah,
So yeah, but the compounding is real, and I think this year will be generally. I expect to continue this growth. I mentioned sometimes in portfolio value, it is not the thing that I look most at, but I need to look at it from a goal point of view because I can look at the yield, but if I look at the portfolio value and the yield in combination, it gives me a better track for the
yeah,
expense coverage ratio because just a PADI for me is fluctuating. There's a lot of currency in there as well with the dollar and such, so it changes sometimes just because the dollar is strengthening or not. So
yeah.
yeah.
What's your thoughts then on this quarter? I know you've started to add a little bit more of your war chest, as you call it. Do you see that progressing this month or this quarter, considering, I don't know, maybe this yield curve is going to trigger a recession, or are you going to hold off and wait and just do your regular?
No. I just decided to spend more every month this year to make my war chest much more empty because the money is not doing anything with a 12% Dutch inflation rate. So no, I just keep dollar cost averaging just a little bit at a higher rate.
Yeah, good,
Yeah.
good.
But this was about me. How was your quarter?
Yeah, I had quite a decent quarter, I believe. I will start with my boys this month. I was quite active. I didn't believe how active I was. But some of these are for dividends, and then some of them that I use that end up either in my portfolio because I have them from selling options, and then some of myself because they get called away. But I I've started a position again in Intel. I know that I had them before and sold them all off. So when they hit around 46, I think I bought 20 shares of them. I did have a put option at 45. It didn't get triggered. And I had another one where I'm a little bit greedier and have a put option that's still open at 40, but that doesn't look like it's going to get assigned. So I'll just keep the premium on that. But I only had a small amount of shares, 20 shares, and then they've shot back up over 50. Kind of want, I just, anytime they dip under 50, I might add 5, 10 shares here and there and just really start to build that position out again. I don't mind buying them under 50, but anything over 50, I don't want to. I don't want to overpay from at the moment. Vitaris was the same, or Beatrice. I always I always call them wrong. Um, but I bought an extra 20 shares of them back in January, which I mentioned. But then I bought another 100 shares after they dipped around $10. I just thought it was too good of an opportunity to leave on the table. So
Oh, nice.
I've 200 shares of them. I bought Siemens at probably the worst time in history. I bought them when they were 145, and about 2 days later, they they dropped to about 120. I don't know where they're sitting now, but I know they haven't come back. But I bought, it was a starter position. I bought 15 shares in them. Look, it's a company that we've analysed. I want to get involved in them, and I've realized that I'm not the best person in the world of valuation. And the more I look at companies, and you use the phrase as a pound, penny wise, pound foolish. So
Yeah.
for the sake of $5 here or there, my estimations could be out. So I just said, look, I started a position, I bought 15 shares in them, we'll see how we go. Again, I want to build them up over time. They're a huge European company, a company that I really like. I use an awful lot, so why not?
So I'm looking at my fair value sheet from all the videos that I make,
Yeah,
and on the 5th of December, I released a video about Siemens. I put then the fair value price at 116 euro. I believe the stock was trading, I don't know, something like 140, 150 euro then, and
yeah.
now it's trading at 126. So it's actually nearing my fair value. So who knows? Maybe I'll buy some when it hits 115 or something like that.
Yeah, I'll definitely average down when it gets down a little bit lower. But said it's a long term game. 145, 15 shares. We'll see how that goes.
Exactly. It's
Uh,
high
and
quality.
and a little bit of that was influenced by the ex dividend date. Maybe I probably got a little bit impatient because I think they went ex dividend 2 or 3 days later. But hey, we'll see how it goes. Pfizer, I ended up buying 100 shares. It was assigned. They've got called away since because I think their share price has gone up $5 or $6 since then. So I don't have them anymore. Texas Instruments, I buy one a month. So I have three extra shares of Texas Instruments. BASF, I have 100 shares of. I think you put on Facebook actually that you are doing dividend capture on these.
Yeah.
And I am also doing dividend capture on these. I bought them at an average price of 52, and
Mhm.
I have a call. Then I'm going to sell a call on 54. So then I get the if they go above 54, I get the €200 capital appreciation. I get their dividend on top of it and the premium as well, which was quite good. I think it was €220. I can't remember
Yeah.
exactly.
We're having almost exactly the same trade here because I was able to buy them at 52 for 50, I think.
Yeah,
Yeah.
and I only benefit because I was in work and I came home and the market was closed, and I think the next day they just went they came straight down, and
Nice.
they hit my price point and jumped straight back up straight away. So I was able to get the call option at a better premium as well.
Nice.
Worked
Nice,
out
nice.
worked out okay. I'd like to say I timed it like that, but it was actually work that did that for me. And the last two purchases I made was one was Walgreens of 100. I bought 100 shares of Walgreens, but again, that's to sell cover calls on. And I bought 20 shares of ZIM, which was a dividend capture that I mentioned last week, which again I have sold. So quite a lot. There was I think overall over the whole month that amounts to about 22,000. But then obviously the sales on that was about 16. So
Yeah.
a net spend of 6,000 for the month, which was more than I thought. I don't really keep track when I'm doing it. I just spend the money. What's quite interesting actually is my dividend. My average dividend for the same 3 months year over year has gone from €116 up to €206. This is after
Mm.
tax as well.
Yeah.
And I've also, because of my promotion, I've included the higher rate of tax in this. So if I was to put that at the same tax level, it would actually be a bigger difference, which is quite interesting to see. My portfolio yield has dropped, so it was 5.49. It is now down to a low of 4.27. Mainly because my Altria got called away. Red Electra is now gone, and
Mhm.
Enegas was gone. So they're really high yielding companies
Yeah.
that I've sold due to options. I have a put option now open on Altria as well. My largest holding is Walgreens because I own 160 shares of them now.
Yeah.
We'll see how that goes. They took a massive hit, so I bought them actually quite silly of me. Actually, I bought them before earnings, a week before earnings. Normally, I wait till after the earnings. I completely forgot earnings was so soon, and they dropped quite significantly. Not that they did badly. I think
Mhm.
that now I haven't read because I was away, but I believe that their forecast wasn't great, and there's a lot of concern. And I think I mentioned this before. Investors are now starting to realize that a lot of it was being propped up by COVID and vaccines and all this, and now there's a lot of concern around that it's not really. I don't know if it's needed as much or what the growth rate of that will be. So those concerns have led to a decrease in price.
Yeah.
So we'll see. I'll probably have to hold on to those 100 shares for a little bit longer, but we'll see how that goes. It also means my largest sector is no longer consumer staples, which was around 30% for about two
Yeah, yeah,
years.
yeah. I remember that.
Yeah, yeah. Now it's healthcare. Healthcare is 27%, so it's not much
Wow,
better. Yeah, and there's no surprise. Walgreens is now my largest gross dividend payer as well at fourteen
wow.
percent. So a lot of weight in Walgreens at the moment, but I mean the 100 shares is earmarked marked for selling covered calls.
Yeah.
Um, I usually do short distance, but if the share price is too far away, I'll go longer distance to increase
Mm.
the premium.
And how do you feel about your portfolio yield? What's your optimal number that you would like to see?
In around 3.5 to 4% is absolutely fine for me.
Fine. Mhm.
So 5% it was quite high. There's a lot of risk. Like if I have a 5.49% portfolio, there's obviously a lot of companies there with a higher yield, which increases the risk. So I've been buying a little bit more quality companies. I've been trying to, not that I added this quarter, but I'd like to get some more Microsoft, Texas Instruments I'm adding. Intel, I believe, is a huge turnaround, and Siemens. So trying to introduce quality and stay away from some of the companies. I know about 100 shares of Walgreens, but that's for options and not really dividend income. But my
Yeah.
focus is to try and pick more quality companies. So there's an exercise that we're doing, and I'm trying to go through my whole portfolio to come up with metrics of dividend safety and see where the companies are going. So I'm in the process of doing that for my whole portfolio, and hopefully start analyzing a little bit more where I should be putting my money rather than guessing. Well, not guessing, but rather than trying to pick different companies every month.
Yeah.
But it's
Well, it
uh,
looks
it's been a solid quarter. My Paddy, as you said, projected annual dividend income is over the 10% at the moment, which is quite good. It's incredible to me, and it was a little bit higher when I had Altria, which got called away. It was near 11%. So it's um it's good, and I have some cash because of that sale of Altria. I've got cash loaded in my account outside of my monthly contribution that I'll be spending this month, as well. So that'll be close to 11, 12%, I would say, by next quarter, which is
you need to celebrate this because for
yeah,
me these are like symbolic numbers. I know they don't mean a lot in itself, but I always think you also need this gratification, right? It's hard work all the time,
yeah.
so
I mean, this time last year it was look, it was 8% last year, and then I think the year before that it was 2 or 3%. So it's growing steadily. Twenty
nice.
percent, 20% is the next goal, and then we'll aim for 50.
Exactly, exactly. I think you should be really proud. I mean, I've been following your this every quarter now, and if I look at that, I mean, also with the companies that you've been buying, I think it's really, really, really going into the right direction. It's really nice to see.
Yeah, you start to develop, don't you, your own methodology. And what I'm struggling with now is that when I originally sat down, I was buying. I can't remember when we started this. I had 40 odd companies, and I remember I wanted to cut that down to 32. And now I'm thinking, 32. There's lots of companies that I would like to own. Do I stick to the 32 or do I not? So it's going to be interesting. That's why I want to go through every single company in my portfolio and just get all the last 10 years data and store it somewhere so I have an easy place to look at it, compare it, and then see what I want to do. But I don't know if I'm going to stick to this 32. I really don't.
Yeah, I'm now on 42 stocks.
Yeah.
So my portfolio goes to have 40. So I already crossed that. But May is always for me the spring cleaning month. So
Oh,
in 4 weeks from now, I will go through my portfolio again, look at some stocks, whether I still want them in my portfolio, whether I still believe in them. And I think that's the biggest question. Because one of the things that I find really, I said, what you often hear with dividend cuts is that you could see it coming, right? So this is what I do every year. At least I take myself a week the time to go through my whole portfolio and answer for every position. Do I believe in this company? Are
yeah.
the fundamentals strong enough that it will still grow 10 years from now? Because I don't look at every position in my company every month to analyze how it's doing. Yeah. I usually focused on the largest positions,
Yeah.
the top 10, but all those small ones that I have, like Allianz, yeah, I see the quarterly results coming in. I look at them. but really deeply looking back at my few one-liners that I have about why did I buy this stock, I usually want to revert back to that because I make some notes around that. And based on that, I'm usually comparing. And that's why, for instance, SAP, I bought it like 1.5 year ago, but last year I also felt selling it again because my understanding of the company was a bit too optimistic. And probably because of the analysis, you can sometimes fall in love with a company
Yeah.
just because you're putting the effort in. And then half a year later, I felt like, no, it's not the company I want in my portfolio right now. Maybe later again when they prove that they can transition to the cloud, but not just like that.
Yeah. Yeah, it makes total sense, and it's a lot easier to do that, isn't it, for American companies because you've got hundreds of sites where you can type in and get all the
Yeah,
financials laid out in nice
yeah,
graphs. And for European companies, it takes us a little bit more effort and
yeah,
more s-
exactly.
more effort on our behalf. So it's something that I'm doing. It's taking me a lot more time than I anticipated. But look, we'll see how it goes. I don't anticipate selling any of my companies at the moment. I'm quite happy with all my positions for the time being.
Yeah,
What
yeah.
do you
So,
think?
yeah.
What do you think on Bayer? Actually, do you still have them?
Yes, yes, I still have them. I have 100 shares in them already for several years. I bought them before this whole Montesanto fiasco.
Yeah,
I always kept them because I thought it was a turnaround play, a value play. I mean, if they price them at 50 euros and they're making like 2.5 euro, no, even more, 6 euro in profit or something like that, then it's just a value play. So that's why I kept them. And now they grew from 47 euro at the beginning of this year to 62 now. The market seems to be starting to be optimistic because later this year we will also hear about the court rulings and such, right? And the verdicts. So I think the market is getting ahead of itself. Pharma is doing quite well. So the business, underlying business, has always been doing quite well. It's just this litigation on top of it. So I just kept it. I thought, okay, from opportunity cost point of view, I always felt like it's too cheap. Yeah, if you think about it, if they would just get clarity on this, I always thought it can pop really quickly, like in a matter of few weeks to 100 euro. So that's why I never sold them. But I must say, I'm now already for 2 or 3 years trading around this price. So my patience started to lose. So it was good to see some price action again. What was also nice to see is that the dividend didn't get cut any further. So and it's still 2 euro. It was also, I believe, 2 euro last year. I believe it's 2 euro. And I don't remember. I'm doing this all by mind. I don't have the date in front of me. I think it was 2.50 euro before the cut, then to 2 euro or something like that, and
yeah,
then it was flat
yeah,
last year. So there's also a floor in the dividend, which is also for me good enough because we're talking about what is it, 4% yield here. So yeah, maybe if Milos is listening from Twitter, now might be the time that Bayer will recover finally because we're always making jokes to each other like what a crappy stock and we're holding on to it. So
yeah. You have, to your credit, said that these guys could pop, and seeing them go from 46 to 60 without any real news or anything happening. I was wondering, was there something going on that I've missed, or is there some insider knowledge or why it has gone up? But it's probably just optimism. And if we do get a positive result on, well, I say we, I'm not a shareholder anymore, but if there is a positive result, then you could quite easily see these guys pop to 100. But then if there's a negative result, you could quite easily see him pop back down to 45,
yeah,
46.
but then the question is, what do I do at 100? Because I lost my confidence in the competency of the management.
Yeah,
So if it's over, I think it has a lot of dividend growth opportunity as well again, because it's just really profitable, the company. But I still don't know about that. I don't. I'm not too confident. But maybe this is the start of something new, and this is so hard for me to decide about these kinds of things because it is for me not anymore the typical dividend growth company. I lost a lot of trust in it. I decided to hold on to it. While usually I sell this kind of stuff, but it was
yeah,
more the value investor in me. But then, should I sell or not? I think it's probably an episode worth to talk about this kind of psychology.
yeah,
I don't know. I would like to know it upfront because I make better investments when I do that when I'm thinking before it, because in the heat of the moment, it's emotion that wants to sneak in.
yeah. I mean, there's two scenarios for you, isn't there? There's okay, the litigation is gone, the story of the company has changed. Because that's the main
Yeah, yeah, yeah.
stumbling block. So what do you think of the company without the litigation, and what do you think of the company with the litigation, and then make your plan from those
Yeah,
two
I can't
scenarios.
answer this question at the moment. I need to think it deeper.
Yeah, yeah, interesting. I'll be interested to hear about it.
Good. So this is probably a nice time to go to the next section of this podcast, which is about the listeners' questions. And we have two today because these came in via Facebook. And the first question is from Simon Stott. And he's asking, specifically in terms of timing, what has been your luckiest and unluckiest stock purchases? For instance, he bought his shares of 3M in the mid of January at 170 and went down, and it was 1 week before the earplugs came in.
Yeah, you remember I was talking about the Tanger, the REIT ticker SKT ages
Yeah.
ago. I bought them at like $17. They dropped to $5. They cut their dividend, or not cut their dividend, got rid of their dividend. I held them, sold them then. What did they do? They reinstated their dividend and they gone back up to $17. So I bought them and sold them at a loss, and I missed dividends, missed the whole lot. So that
Holy
was one
shit.
of my unluckiest ones, which is quite funny. My luckiest one must be probably Microsoft or Shell. Either one. Shell was a bit more, I would say, long term, but Microsoft, I was debating whether to buy them or not. I want them to dip to 180, bought around 200, and then they just shot up to 290 or something. So
Yeah.
um, they would be my ones.
So I think for me, Johnson and Johnson. I bought Johnson and Johnson at $115 in the pandemic crash. Like literally, I think if you go back there, it was probably somewhere the bottom, probably an intraday bottom even. And then my unluckiest, I think we spoke about a buyer, right? I bought buyer. I was accumulating a position, and then they bought Monsanto, and then the shit happened. So yeah, but Johnson Johnson is maybe not even the most luckiest, the most proud on, because I've really felt like bottom fishing. Like usually, like Beatrice, I initiate a position, and then it crashes. And even someone on Twitter said, like, why do you buy today? Why don't you wait a few days? Isn't it a falling knife? I said, well, I don't know. So why then not buy today? Yeah.
Yeah,
and then I bought it, I don't know, 11.40, it went to 10, like, and then you bought it,
yeah.
right? It's the same with Baba, I buy it under 70 and you buy it at fucking under 30 or something like that. I mean, I just need to listen more to you. I'm usually early with my first buy, but then later with my second buy, I must
Yeah.
confess. So I usually do better with my second purchase.
Your Johnson and Johnson one was, I've just checked, it was an intraday low, so it didn't close. It didn't close at 115 any time on the
Yeah.
last since 2018. It closed at 119 on the 20th of March. So on that day, it dipped to about 115, just under 115. So you bought the intraday low. So you actually timed the market. Actually timed the
Yeah, but
market.
this how it works with me, right? I put purchase orders in based on the fair value minus margin of safety, and I
Yeah,
usually have 4 or 5 stocks. So when the pandemic broke out, I put for my high quality stocks in there. So only Johnson Johnson got triggered at that moment in time, not the others. But yeah, it made me really proud, of course, that I could even do this.
patience. Patience is key.
Exactly.
And the second question, it's a question based on last week when we were asked about these REITs or these different types of ETFs called QYLD and JEPI. And Kenneth has said, did he understand us correctly that we couldn't buy them because we're in the EU? He's in Denmark, which is also, which I mean, is also in the EU. So can he or can he not buy them? So I think the key is that it depends on the broker. There's been some people say that you can buy them in Tastyworks. I don't know. All I know is that in the Giro and in Interactive Brokers, I have no access to these, and it's purely
Yeah.
because of this key kit, this key investor document that they
Yeah.
need to provide. So, but there seems to be ways around it, but I just don't know how that would stand up if with tax, these guarantees or with tax and all that. I don't know how that works, but I know my two brokers, I can't buy them.
Yeah, exactly. Well, this is really interesting, and that's also so nice why we have this Facebook community. So both these questions came via the Facebook group. If you are not member yet, come to facebook.com/dividend talk. I believe that's it, or groups/dividend talk, and you will find us there. You need to answer two questions, I believe, to keep the spammers out. And by the way, we still sometimes get spammers. I don't know why they even take the time, and because nobody is bothered by it. But anyway, the group is really getting active. So, and these kinds of questions are asked there, right? We have by no way time to address all these kinds of topics in the podcast in a really quick time. So if you have these kinds of thoughts in your mind, just join the Facebook group, and there's always someone who will answer your question. But going then from maybe not a listener question, we also got a person reaching out for us to do a portfolio review.
Yeah, Claudius reached out to us by email and sent us on his strategy. I'll just talk a little bit about his strategy and then some of the companies in there. And he wants our honest feedback on what we think. So his main strategy is around ETFs. Um, so he has a diversified ETF portfolio. He invests around €1,200 per month, €1,000 in the Vanguard, FTSE All World, and then the rest in some real estate ETF. I'm not aware of the real estate ETF. I think it's Van Eck Global Real Estate. I'm
Yeah,
not
Van
sure.
Eck is a really, really good,
Okay.
I would say, mutual fund house, ETF house. I think
Yeah.
it's probably a Dutch one. They have some really good funds or ETFs to invest in, I must say. Also, one of the dividend growers is of a quite good quality, I must say.
Okay. And then on top of that, then he's pretty new at the stocks. So he's added stocks, individual stocks, into his portfolio. So I think he started in 2020. It's a steep learning curve for him. He's mentioned he has companies like Nike and Domino's. He's no intention to sell them. It's like a hobby for him. So he's obviously passionate about this and enjoys the research and enjoys getting involved in these. But some of the companies he has, I'll just talk about some of them. He has got Mondelez, which is a great European company that I don't hear enough talked about. It's huge. He has got British American Tobacco, Louis Vuitton, Porsche, Nike, Lockheed Martin, Unilever, um, some quite some quite good companies there. Texas Instruments and McDonald's as well. So, what are your thoughts on his strategy and company?
I think he has a very solid strategy, I must say, and the companies in there are really good. And one that also speaks to my imagination here is Defama, because they have the coolest CEO. He's on Twitter. It's a German guy. Effectively, he builds the Lidls and the Aldis in Germany. That's the company is about. I think it's a low yielder, so it's with ticker symbol DEF on the German stock exchange. I believe the probably the yield is around 2% now. And for a real estate company, or let's say a building company, it's not so much. It's also richly valued, but the CEO is really active. I think he is. I think if I remember correctly, he did a Twitter. How's this called? Twitter Space for the annual
Yeah.
results
Oh
back in
wow.
March. So and he has shares in this. So he's around on Twitter, I guess.
Yeah.
Otherwise, you don't easily get to this stock. But look, he has he has really high quality companies in there. I mean, Louis Vuitton. If you think about Microsoft, Berkshire, Porsche, these are brands, right? Brands that will still exist 10, 15 years from now. Doesn't always make it a good stock, but if I look at this list, I'm quite impressed. There are also some growth stocks in there, like Alphabet, Amazon, also Monster Beverage, right? But all in all, I think it's a strong portfolio. What I'm maybe missing a little bit from a dividend growth investment point of view is some more high yielders, like based on our conversation from last week, right? To spice it up a little bit. Although, if you look at it, yes, of course, British American Tobacco, which is a really nice yield in between here. But all in all, I like also the diversification of the portfolio. So if someone tells me that they rather recently started with this, then I'm pretty much impressed because I wasn't so wise after 2 years of investing and reading so many blogs. I couldn't compose such a nice portfolio by that time. So Really impressed with this.
Yeah, to his credit, I think he's investing longer than 2 years. It's just the individual stocks in 2 years, but he seems well versed. The 25% in Vanguard or World ETF, to me, this strategy is perfect for most investors. I think, and I've always said that I think for most investors, ETFs are probably a good way to go.
Yeah, yeah,
My
yeah,
my
exactly.
circumstances are different, and it does take a lot of time to stay on top of an individual portfolio made of all companies and stocks because things change completely. And we notice that the more we do these shows, the more annual or quarterly results that we do, we see stories change. Like we're talking about Bayer there for a moment. That story can change quite quickly. So it does take a lot of work. So I think having overall was it 40% of his portfolio in ETFs. I think that's a very wise
Yeah,
move. In terms of his companies that he picks, I think he has a nice mix of growth and dividend. There's some top companies there. I know he says that he's overpaid on some of them, but hey, look, none of
yeah, but
these
come on.
none of these
Uh,
companies are going anytime soon.
yeah, and his largest position is Alphabet, and I believe that Alphabet is still relatively cheap when you look at its cohort.
Yeah,
So if you think about from that point of view, I mean, all of these companies, I think, will be much more worth 10 years from now than it is today. The question is, of course, the rate of return you will get on an annualized basis. But a lot of these have a strong moat, right? I don't see why Berkshire Hathaway would tank anytime soon. And of course, it doesn't pay dividends, so you need to have some share price appreciation.
yeah,
But most of these companies are really solid.
yeah. I mean, these top three are Alphabet, Amazon, and Berkshire Hathaway. His top three dividend companies are Microsoft, British American Tobacco, and Louis Vuitton. So, I mean, they're six really, really strong companies. Looking at his list, okay, I don't know some of the companies. I don't know someone, for example, IVU Traffic Technologies.
Me
But
neither.
but the only company I would not buy on this list is Starbucks, and that's because I just don't like Starbucks coffee, and I'm not a fan of. I mean, but
Yeah,
I know you. I know a lot of people do like these. I mean, it's a really strong portfolio.
I like Starbucks, the company, a lot, but I really have issues with the stock. And I did a video about it most recently, and when just before the no, just when the war broke out, I have really issues with their balance sheet. That's
Yeah,
just what really prevents me to easily buy something there. Um, yeah, yeah. I
yeah,
think once again, I think it's a really strong one. The one that I wouldn't buy is Deutsche Post.
yeah,
I know probably there's a lot of sentiment towards German stocks when you're from Germany, but Deutsche Post, I would not touch it. I've looked in it a few times. Also, this business is really low margin and really competitive. I don't see a lot of future for such companies. Also, when you think about it from a dividend growth point of view,
yeah,
right? I don't find their dividends safe.
yeah. I'm happy to see Mondelez there though. It's a company. I mean, people don't realize how big this company is. It's probably as big as Nestle and Kellogg's. So I haven't seen many. I don't know if I've seen any portfolio with these guys. Maybe the kind of capitalist has them, maybe, but I haven't seen anyone else with them in their portfolio.
Hmm.
So
Yeah,
interesting. No, good job, good job. I think it's a really strong strategy and two really strong portfolios.
yeah, super. So having said that, then let's go to the last section of this week, and it's a stock pick. And I would like to share the stock that I actually made a video today about, and that is T Rowe Price Group. It is trading currently around $152. And, this company has been popping up on my timeline for the last 2 years since I'm active on social media. And before that, I saw bloggers writing about it, and I felt like, ha, this whole company, it doesn't resonate with me. I don't know the name, so I never was bothered to look into it. It was, I've got a Trello backlog where I put all the stocks that I should look into one time, and I promised, and I just forgot who, so sorry for that, but I promised someone to look into it.
Yeah,
I looked into it and I was blown away. I mean, you need to look at the video that I created as well, I would say, to get an in depth analysis. But all my statistics in my one pager are on green. This hardly ever happens. And I know there is a bit with free cash flow in there that makes it look maybe a little bit better than it needs to be when you look at the free cash flow growth rate. But other than that, it has a strong credit rating. The return on invested capital is like 34%. 34%. This is crazy. And I know they come off a really good year, right? During the pandemic, lots of influx of mutual funds. And this is also how the company earns its money, right? So maybe I forgot to introduce it, but T. Rowe Price Group is a mutual fund company, let's say, investment vehicle. It creates funds, people invest in it, retirement funds put money in it, they dollar cost average in this, and they take a fee. And this fee is what they earn their money with. So what is really important for this company is assets under management due to that. And that's the accumulation of all the money that's invested with them. So if this grows, their fees will grow, their income will grow, and such. Now the risk here that I looked into it, I would say is also it is highly sensitive to stock market prices, because if the market goes down, many people tend to withdraw their money, and then the assets under management will decline, and then the fees will decline, and therefore the revenue and the income. I think the dividend is, by the way, very safe because it has a low payout ratio. It's conservatively managed, no debt on the balance sheet. I love it. So, I mean, uh, if there comes really a debt crisis that will really tank the share, I said no. If there comes a debt crisis that will really wash out so many people and their investments, and we're talking, by the way, more at institutional investors here as well, but if they make a giant wipe out and the trust is really low, then maybe this dividend can be at risk, like half of the rest of my portfolio. Other than that, I find a really safe dividend, and I just loved everything that I saw. My fair value for the company is $172. It's trading at $152 and a bit. So I'm considering opening a position this week. I probably just do tomorrow morning when I log into my broker and buy a few shares just to initiate a position.
Nice, nice. I know Dividend growth investor likes these guys a lot. Looking at the numbers you post here, I mean, I know you said they come off a great year, but they have 36 years of dividend growth. So they've gone through a couple of recessions, a couple of bad years, and still managed to raise their dividend every year. And a payout ratio, I mean, free cash flow of 34, earnings of 36%. They have loads and loads of room to grow and keep growing. And it's
Yes, and it's already a yield of 3.14%, right? And
yeah,
it dipped, I believe it dipped to 140 or 135 like a week ago or 2 weeks ago. So, and then this is what you need to know. I think the share price in the great financial recession dropped by 60% or 70%. Yeah, you need you need to be fine with this. And the price was trading about $200 a few
yeah,
months ago. So someone asked me also, like, why did it drop since then? It simply dropped since then because the market was more turbulent. People are expecting a recession or something like that with the inflation and everything. And this is just bad news for such a company if you
yeah.
think about it, based on the risk that I just mentioned. So it dropped already 25%. It can easily drop another 25%. I wouldn't be surprised if we see it. If a crash happens or something like that, we see it trading between $70 to $100. Then I'll be loading up the truck.
Yeah, it was $90 at the last crash in 2020. So that's probably a
Yeah.
good benchmark for it to drop again. And looking at the share price, it does look in an upward trajectory, but it looks like 10-20% drops are not uncommon for these kinds of companies. So I
Yeah.
think patience can be used on a company like this because we do know that it's going to come down in price as well as go up. So I think patience is key. But I'm aware of the company. I know it's a quality company. It is also on my watch list. I actually wanted to buy him around the crash, and I don't know why I didn't. I think I bought KKR instead. But it is a really good company. So
Yeah. And so this is just a stock where you shouldn't look at the share price, but where you should look at the dividend chart. That's the only thing. I think if you look at that, it gives you peace in mind.
yeah, if you're a dividend growth investor, if you're anything else, don't look at the dividend chart.
Exactly, exactly. Hey, this was it from my side. So I like this stock a lot. If people are interested, look it up on YouTube. Go to my profile. You'll see this is the latest video. And having said that, I believe this is the end of the show, my friend.
Yeah. It was a nice show. It's always good to hear how you're progressing every quarter. I know we do a monthly check-in, but I think the quarterly one is always a little bit more exciting for me. And
Exactly.
also to our listeners, I mean, we love hearing your journey. Or so please share with us on Facebook and Twitter. I do read all the posts. I'm not always active in writing back because when I'm reading them, sometimes I'm in work or just quickly checking. But we do read everything. So please share your journey and how you're doing.
Good. So having said that, everyone, have a great week and see you next week again.
See you next week.